What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Happy CPI Day. Today, the BLS in the United States released September's CPI numbers. I don't like to call them inflation. Lots of people are already getting it mixed up about, hey, this means inflation is higher or whatever. No, this just means prices. It's all about prices, not about actual money printing. But we are going to go over what we saw today. So let me quickly share my screen. This should be a pretty quick episode here. Bitcoinandmarkets.com. Check out the website. All right, here we are at the bls.gov/CPI. And you can see here, CPI for all items rises 0.4% in September, shelter up. We're going to click into this. Now, before this dropped, right before this dropped, I was not able to live stream the actual drop this morning, as you guys can tell, but I did put a few minutes before, I put a little blurb into Telegram about the expectations, what my expectations were versus kind of, Wall Street's expectations. And I did expect it to actually come in under the forecasted 0.3%. And I said I wouldn't be surprised with 0.2, but I would be surprised if it went the other way of 0.4. And that is actually what has happened here. So let's read into this. So the CPI for all urban consumers rose 0.4% in September on a seasonally adjusted basis. And I talked about that yesterday on the live stream, I think, about the seasonally adjusted basis and why that hides a lot. I get why they do it. And I think that most of the time, it is a best faith effort to get the proper smoothing to all of these numbers. But one reason why people don't see seasonality coming, why people never see pivots at the end of Q3 or crashes, plus or minus a couple weeks of the end of Q3 or the end of Q1 even. The reason why people don't see this is because everything is seasonally adjusted. And it just looks smooth. And it tricks us into not understanding the crunch points. There are natural crunch points in the year. So anyway, just wanted to bring that back up again. Seasonally adjusted basis after increasing 0.6% in August. So it did come down on a month-over-month basis, at least the rate of change. A lot of people like to bring that up. The rate of change went down. It's still increasing month-over-month. So there you have that. The BLS said today, over the last 12 months, so this is year over year, all items index increased 3.7% before seasonal adjustment. Okay, so that's before the seasonal adjustment. Very interesting. And 3.7%. Now that obviously the target is 2%. There's been a lot of talk about increasing the target to 3% because a lot of people think that there's going to be this long-term or long-run higher CPI numbers, which I don't agree with. If you just look at the chart, it has actually been transitory, and people still kind of laugh at the people who say it's been transitory, but it really is. Some of these things take a long time, like this shelter, which they're going to talk about here. Shelter has a huge lag in it. If you think about the effect of rising rents, you're not going to sign a new rent or a new lease every month. You're going to sign it once a year, or maybe, some places you might have 2, 3, 5-year leases. I don't know. I know that's more common in Europe, but there's probably places in the United States that are like that. But there is at least this built-in 1-year lag. And then when you talk about owner equivalent rent, where homeowners estimate what they could rent their property for, that's an even longer lag, because they will start seeing these leases going up, and then it takes time for them to price it into their expectations of the market. So there's this huge lag, and it's the same on the downside as well. But these things happen in consecutive order. Okay, that one reason why they take for core, they take out food and energy because food and energy is very volatile, but it moves very, very quickly at the beginning and at the end. You have other parts of the index that will move sooner. Shelter is always the last one. So if everything is coming back down, shelter is going to follow. And I thought that it would have followed more by now. I thought we would be down into the 2% by this time. But, what's the difference between 2.9 and 3.7% for a year over year number? I mean, yeah, it's significant in the long run, but timing a kind of transitory fall, it I don't think that's very significant. I mean, it could drop 0.5% in 1 month, if we get a real low print in 1 month. So uh, being off by 1 or 2 months is not being wrong. Directionally, everyone that's been calling for longer, higher for longer, and 9%, 10%, 20%, shadow stats saying that we're at 20% CPI or 20% inflation for 20 years. Those people were directionally wrong. At least I'm directionally correct. I'm just a little bit either slow or fast on these things. But okay, the index for shelter was the largest contributor to the monthly all items increase, accounting for over half of the increase. And this has been the case for most of the year, where most of the increase has come from shelter. We're going to take a look at that down here in the table in a second. An increase in the gasoline index was also a major contributor to the all items monthly rise. So let me mark that down to take a look at the gasoline chart as well. Gasoline futures when we get to the charts, because that has also come back down. Where we go here. So while the major energy component indexes were mixed in September, the energy index rose 1.5% over the month. The food index increased 0.2% in September, as it did in the previous 2 months. The index for food at home increased 0.1% over the month, while the index for food away from home rose 0.4%. And just anecdotally, I have been noticing the rise in prices really, really slow down. I like for red meat and stuff. I pay attention to the cost of steaks and the cost of hamburger, and stuff like that. And it has actually started coming down, at least where I live here in Northern Florida. It has started coming down. So, different items within this basket are going to act differently as well. It's very hard to build a product basket and waiting. Like right now, orange juice is at all-time highs and just continuing to go higher. But that's one little item. How much weight do you give that? There have been times where there has been an outbreak of avian flu or whatever within this highly susceptible population of chickens in the United States, and they have to cull millions of birds and now pop the price of chicken. Okay, well, that's not a money printing problem. How much do you weight that for what CPI is meant to measure money printing? It's meant to measure inflation, but how do you weight that? Another one might be pork. If there is some shortage of pork, or during the pandemic, we saw problems with the pork processing plants where they had, huge amount of people out or sick, or somehow they lost half of their workforce, at least one shift out of 3 of their workforce, and they're not going to be able to produce as much pork. The price goes up. Is that a money printing thing? Is that an inflation thing? No, it's not. So how do you measure this basket? It's a very, very hard job, and it's not as easy as what I used to think and what most people, most inflationistas out there think. Oh, it's so easy. You just measure the prices of things and voila, you have shadow stats at 20%. It's not that easy. There's a reason why the baskets change. There's a reason why weighting changes. They're not always perfect, but I'm going to tell you that most of the time, the government officials who again, most of the time are acting in good faith, they are going to be have better reasons for what they do than the inflationistas on Twitter. Just okay, let's get into this a little bit more. The index for all items less food and energy rose 0.3% in September, the same increase as in August. So core is pretty flat, at least the rate of change is flat. Let's see. Indexes which increased in September include rent, owner's equivalent rent, lodging away from home, motor vehicle insurance, recreation, personal care, and new vehicles. The indexes for used cars and trucks and for apparel were among those that decreased over the month. Okay. Blah, blah, blah. Let's go down here and check out the table here. You guys can all do this as well if you would like to. I do this every month, but shelter right here is back in March. Okay, starting in March and going to present, we had a rate of change 0.6, 0.4, 0.6, 0.4, 0.4, 0.3. And I was talking about how last month I was talking about how that's coming down. Well, this had a big boost in this last month at going back up to 0.6. We'll have to see how that evolves in the next couple of months here. But that is more than half of this increase came from the shelter component. I think this shelter component is like a third of the entire CPI. A third. Energy is roughly a third, maybe a little bit less. So like this is a big thing. If shelter is continuing to accelerate for whatever reason, it doesn't have to be a money printing reason. Remember, I just went over that there's all sorts of different reasons for different things to go up and down. Now, shelter could be going up for obviously a non-money printing reason. If it's going up, now get this. This is crazy. So if it's going up because rates are going up, right? Rates are going up, so then your monthly payment is going up. Okay, so monthly payment is going up, but fewer people are taking out mortgages. We're at like record lows. We're below the lows during the great financial crisis for a number of new mortgages. So fewer people are taking that out. However, the average monthly payment, new monthly payment, is going up. That could affect owner equivalent rent. So the owner equivalent rent, they look at what is the average monthly payment for new mortgages in their area, the comps in their area. And that's going to increase their owner equivalent rent estimation. Even though they're basing this off of a deflationary force. Fewer mortgages, less amount of dollars being created in loans. So it's a deflationary reason to increase owner equivalent rent and make the shelter component go up and CPI component go up. See, it's very complicated, all of these different things. So you got to be able to break down this. And I'm not perfect, but I'm saying it's not as easy as what the inflationistas on Twitter say that, oh, there's all this money printing going on. No, there isn't all this money printing going on. Okay, so let's take a look at the charts, see what the reaction has been. This is Bitcoin. Let me bring up the EMAs because we are still holding on barely to the 50-day moving average. And I'm going to share that with Telegram. You guys might hear my mouse clicking. I had to get a new mouse. I'm having a big time computer problems, guys, but I did just get my new computer box. I'm setting it up today, and we should be good to go here. Okay, so we are sitting on this 50-day moving average. We will see what happens here in the next little while, but higher CPI should be interpreted by the market as higher inflation, which if Bitcoin is an inflation hedge, it should go higher. However, what we saw over all of 2021 and 2022, when we had the high CPI prints, what happened to Bitcoin? It was going down. It wasn't until the CPI started falling that we had the best year so far, or out of the last what? Well, this year has been up about 60% on the year. But if you look at 2022, when we had the really high CPI prints, it was down on the year. So is Bitcoin an inflation hedge? Yes. Is Bitcoin a CPI hedge? That's a different question. See, you can't judge inflation off of CPI. You really have to judge inflation off of the behavior of inflation hedges and the behavior. I mean, big time. Oh, I hit my mic. Sorry about that. Behavior big time off of gold, I would say. Not so much Bitcoin because Bitcoin is very volatile, but CPI is not quote unquote inflation. Lots of things can come together to create a CPI number. And yeah, so Bitcoin is not behaving as if this were a higher print for inflation, but it is acting this way as if it's a higher print for CPI. So, okay, let's look at some others. What did I say I was going to look at? Gasoline futures. And take off these moving averages and zoom out. So gasoline futures didn't do much, but you can see since September 13th, or even if we go back further to August 11th, big time high there, and it has gapped down and it's just continued to fall a ton over just the last week. Let me measure some of this. So let's go from September 28th, the open on September 28th, to now. It's down 14% so far this month, basically. So that is the gasoline futures, and that contributed. What did the BLS say? That contributed a lot to the CPI print. And I'm going to copy that, send it over to Telegram. All right. What else are we looking at? Let's take a look at what the stock market did this morning on this news of supposedly higher inflation. And not much. I mean, it's pretty much flat for the last 12 hours of trading. The futures, it looked like, dropped down. It was going, it was looking like it might break out here. 44.26 on the S&P 500's futures, but now it's down to 44.03. I mean, not a big move. Who cares? So that this CPI does not matter to most people here. The U.S. oil, this is the WTI futures, of slightly higher, but nothing significant. So even though this was a big beat, there's not much going on here. Now, the dollar did react. Let's measure this out. The dollar did react this morning to the CPI, and it is up a little over 0.5%. So that is a pretty big move in the dollar. But if we zoom out to the daily, it still has a lot of work to do to get back up above, say, well, just to get back to 107 is going to be a lot of work for the dollar. I don't see that happening. All right, let's take a look at this post, and I'm going to share this link with Telegram real quick. All right, that's the article that I'm going to be going through. The headline from Zero Hedges: nothing here to convince Fed to hike in November. Wall Street reacts to today's CPI. There are two diverging views following today's CPI print. The first looks at the hotter headline inflation, which beat expectations on both the month-over-month and year-over-year basis, and argues that the Fed will have to hike at least once more. The second counters by pointing to the continued slowdown in supercore inflation. Now, the Fed that's what they're worried about. They're worried about supercore. That would be core minus shelter. So taking out food, energy, and shelter. But they also are looking at the PCE deflator from the PCE. So not CPI, but the other price measurement out there that comes out later in the month. So that usually comes out towards the end of the month, where CPI comes out at the beginning of the month. But yeah, this is a good little conversation they're having. And notes that excluding shelter, which, as we noted, continues to lag real-time data by 12 months at a time when rents are now dropping. So rents are dropping, but owner equivalent rent could be rising. You know, like I said, that there is a lot of different ins and outs of what goes on with shelter. So this is a quote from Zero Hedge. I'll skip that. Core CPI is up just 0.1%. For a more granular view of Wall Street's takes, here is a snapshot of initial hot takes from a variety of traders and economists. So, Capital Economics said, excluding shelter, the core CPI rose just 0.1% month over month. Overall, there's nothing here that will convince Fed officials to hike rates at the next FOMC meeting, and we continue to expect a more rapid decline in inflation and weaker economic growth to result in rates being cut much more aggressively next year than markets are pricing in. Okay, CBK is saying U.S. inflation is cooling, but only slowly. Oh, I did see that, like, the Dutch, was it Dutch? I think it was inflation in the Netherlands was all the way back down at 1% or something already. How can that be? Well, because other places use different measurements of CPI, and Europe tends not to include shelter, at least in the same way that we include shelter here. So if, X shelter, look, we're down at 0.1% month over month. That is what Europe is facing right now. So Europe's inflation is moving down faster than the US. All right. From the perspective of the Fed, the figures are probably not worrying enough to trigger another interest rate hike. However, they are not good enough to sound the all clear either. Okay. Wishy-washy. From MUFG, the Fed is done, as its recent commentary suggests, a shift from already thinking of moving from how high to how long. I also saw some other Fed people come out. Bostic was one of them, I believe, that said, hey, we probably are done. And all of these Fed comments are the monetary policy guys. They are little monetary policy tweaks. We were seeing the 10-year race higher, right? They said, people are saying that is the equivalent of another 1 or 2 hikes from the Fed. How that is when it's still under the Fed funds target range, I don't know. But yeah, they're saying that has done the work for the Fed of any more hikes. So that was just a couple days ago. They're already signaling that they're going to continue to pause. And as this George Goncalves says, that the Fed has shifted it to, instead of how high, to how long. Okay, Richard Bernstein Advisors. This is one of those reports that will be forgotten almost immediately. Oh, what did I say about the reaction from markets? It doesn't seem to be like anybody cares about this. And this is what these guys are getting paid about 100 times more than I'm getting paid. Yeah, it will be forgotten almost immediately. Okay, BMO Capital Markets. Overall, it was a firm read on realized inflation that forces the Fed's recent messaging regarding the need to keep policy rates in restrictive territory for an extended period of time. Okay, that's fine. But if the market doesn't agree, the Fed will follow. The Fed will follow. The Fed can't keep rates for an extended period. The market really doesn't care. They will do what is needed when the time comes. You can just go back and look at history of the Fed fund or the Fed policy rate and say the 10-year or even the 2-year. These things don't obey. They move, then the Fed moves. That's how these things work. Bloomberg Economics. The September CPI report won't convince the Fed officials that interest rates are sufficiently restrictive. There's some encouraging disinflation progress in the goods sector, but not so much in services where rents disinflation stalled, correct? The Israel-Hamas conflict has now tipped the balance once again towards upside inflation risks. I don't think so. I didn't plan to talk on this, but look, if this conflict causes prices to go higher, that is not a positive for credit creation. See the confusion that people get into when they talk about inflation as prices. I went in a long tangent on this on the Mark Moss show when I was on there last week. I don't know actually if that has come out yet. I'll have to reach out, see if that's come out. But this is just confusion completely based on a bad definition of what inflation is. If you call everything inflation, you can't even talk logically about things. So this conflict, if it raises prices, if OPEC thinks they have to do some sort of retaliation, which is not at all guaranteed by any means, I think that's probably a very low probability of outcome here. But if OPEC says, oh, we have to restrict supply, they know they're going to destroy demand. There's going to be demand destruction, which is bad for credit creation and bad for going into a recession. They know that. So this conflict is not shifting the balance towards upside of inflation. It is shifting the balance towards upside of prices, which is actually shifting the balance towards a downside in inflation or deflation. All right. That's all for this one. Let's take a look at the Fed monitor tool. I have looked at this with you guys before, but this is from investing.com/central banks/Fed rate monitor. And so November 1st, this is looking at the probability for the associated policy from the Fed at their future meetings. Okay. So the November 1st meeting that will be coming up here in a couple weeks, it's an 86% chance that they won't move. And I think that's going to grow as we get closer. And remember, the Fed does not surprise or do anything to the market. They follow what the market wants. Okay, let's look at December. December, it is actually, I think this has gone up slightly for one hike here in December, but the overwhelming majority of what the market thinks is a 60% chance that they won't move in December either. January, same, about a 60% chance. That's almost identical, actually, from December and January, which is interesting. Let's go into March. Here we first get, in March, we get a probability, 12% probability of a cut. But the overwhelming opinion right now of the market is that they will continue to pause here out to March. Let's look at May. The May meeting, we start getting a much higher probability of a cut, 34% of a cut, 40% of continued pause in May. All right, now how about June? Okay, now June, this has flip-flopped. It actually went out to July last time, but now it's back to June. So June now, the market is pricing in the highest probability of what's going to happen in the June meeting is a cut, 36%. And in 34% that it stays where it is. They maintain higher for longer, all the way out to June. Now here in July, it's starting to get a bigger dichotomy. And actually, two cuts takes the second place away from maintain at the current level. And one cut is over a third probable at the July meeting. Okay, one more. Well, let's do a couple more they have here. September 25th, it's starting to get bad here. So by September 25th meeting next year, so that is almost a year from now, there's 18% priced in, 18% that we will be 3 cuts in already. 2 cuts is the most likely by September, followed by only 1 cut. And higher for longer at current rates is in 4th place. And last one they have here on the Fed monitor tool from investing.com is the November 6th meeting. So this would be more than 1 year ahead. And man, there's almost no chance we're going to be higher than today. And there is starting to be a chance of many, many cuts, 4 cuts up to 4 cuts at 16.2%, 3 cuts at roughly 30, 2 cuts at roughly 30. So anyway, I watch this on a regular basis. I'll make sure to keep you guys updated. And that's all I have for today, guys. Check out bitcoinandmarkets.com, support my work. Check out the Telegram, t.me/Bitcoin and Markets. Find me on Twitter at Ansel Lindner. And you guys have a good rest of your day. Bye.